Welcome to Property and Paper Live. My name is Dawn Rickabot. I'll be your host, and this is where we talk about anything having to do with real estate, owner financing, and notes. And of course, we know that seller finance property is what gives birth to the note business. And I'm actually having a lot of fun. I'm finishing up that Note Investing for Newbies book that I've been working on for a while. And so I'm really still having a lot of fun with that. I'm always like, hey, you know what? Understanding a little bit about the note business will make you a better real estate investor. And yet I haven't had any simple little book that people could learn a little bit about the note business and how to get started, even though we talk about it all the time in this venue. The only thing basically in real estate that I hadn't done that I just wanted to fill the gap. And so I did a deep dive just with what's the wholesaling world about? What are their problems, their concerns? Because I think a lot of ways, if I understand the wholesaler's mindset, that I can, add value as they're leaving a lot of money on the table, not knowing how to convert those. They don't know much about the note business. A lot of real estate investors don't. When you know the note business and you understand that, then you understand the seller financing backwards and forwards, and you could put more deals together. And why not wholesale two things instead of one? There's a lot of opportunity that a lot of wholesalers are leaving on the table. In this group of wholesalers are like, oh, we know all about notes. We'll hook you up with this guy that's doing, there's more than one, I guess. So I'm not even sure what name he put out there, but you know what? They're doing a ton. They're buying land and they're creating these notes. And I think this could be great for you. And I go, oh, thank you so much. But I have seen a lot of that paper and I have said, no, thank you. Those will be notes that new people to the business will buy because they're looking at yield and not the overall risk and reward. So I'm going to bring up, and I promised to just talk about a deal. I guess this person found me on LinkedIn or something. Number one, they had a note secured by a mobile home park. And at first I was kind of like, okay, good. I like notes secured by a mobile home park. But then it's like, oh, well, it's in second position behind a 70% bank loan. And there was only a 15% down payment. I go, I can see how it got to where you're bringing that to me because nobody else is touching this. Right. But anyways, well, here's a couple other real good deals. And so let's look at them and we're going to talk about it. And I tried to be respectful so nobody knows what exactly it is. So here's the little, I guess, the slide deck. The first thing that made me smile, the very first thing is this right here. $94,000. Market rent is $1,000 a month. Insurance, $60 a month. Taxes, $75 a month. Principal and interest, $870. They're putting a down payment of $5,000. So basically what they're saying is for the price of rent, we're making these people homeowners if they'll put $5,000 down. So here's how I think they came up with the value of the property. It's worth this to someone who gets these terms. Gosh, we could rent this or we could sell this. Okay, so, and they go, we know someone can afford $1,000, but we're going to minus out what we know they'll have to pay for taxes, what they'll have to pay for insurance. So then they figured, oh, this is the value. This is the owner finance value, because if they get these terms, that's what we reverse engineer into it. So you can see, we're seeing 94,000. So that's what they did. This person can afford this payment. We want at least 7.5% on this, 15-year fully amortized. So voila, we pushed this button and we figured out what the value of the property was. Is that how we normally value property in the normal real estate world? I guess sort of. I mean, property values go up when interest rates go down, right? People are paying $100,000 more for a property if they can get 3.5% instead of 6 or something, right? I can see what their point. Hey, they can't rent a place for anything else. They've already put down 5,000. So ostensibly their whole life has to fall apart before they can't even afford a place to live, right? I get the thinking, and I'm not saying that that's a bad thing. Just so that if you're new and you're out there looking at opportunities that the seasoned investors won't buy. And they're hoping, in fact, there's even someone out there selling notes for more than UPB, more than the balance plus arrears plus penalties. If they bought it at the price these people were selling it at, when they refinanced or sold the property and it got paid off, they'd lose money 5, 10, 15,000 day one. And there's people buying those. These are people that are not knowing much about the note business. If someone puts out something for sale and someone will buy it, hey, why not? Note business has gotten so big, oh, notes, and it's still obscure enough that it seems like you've stumbled upon this really, secret weapon and you need more yield. But unless you've been in it a while and see how the movie plays out, you really don't know the value of it in the overall context. Let's see what else this thing says. All right, 3 bedrooms, 1 bath, blah, blah, blah. Okay, it's cute. So here's it is. Owner finance value, $94,000. The investor purchased it at $45,000. And he wants you to put up $50,000 and he'll pay you 12% interest only over 5 years. So that can look really good, right? They want $50,000 from you. You be the note investor. You're not really borrow. Maybe in this situation, you're just lending the investor the money and he's going to collect the $870 and he's going to pay you. And here's how you guys know how to do interest only. I'm going to show you 2 ways, just in case you're brand new. You can say $50,000 times 0.12, because remember percent, if you're getting paid 12%, move the decimal places to the left. And that gives you're going to make $6,000 a year divided by 12, $500 a month. So he's going to get $870 from the occupant, right? He did the owner financing here. He can buy it for $45. He's borrowing $50 and then saying that you're protected 53% loan to value. And we'll check that out. So anyway, here's what's on the table. You can make $6,000 a year for 5 years. So not bad. Right? That's great. And your loan amount is, I was going to show the other way. So sometimes the other quick way that I just figure out is that I then throw this as a negative number, right? Because it's interest only. So now he's taking $50,000 and it's divided by the value of the property. Of course, and he's saying it's $94,000 because we reverse engineered the payment stream to figure out what the value of the property was. We didn't get an appraisal. We didn't look at Zillow. We blah, 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 right? Okay, so that's where we say you're only at 53% loan to value, but this number, this value, while it may be fair, and this may be a reasonable deal if you know what you're getting into, and maybe you're local even there to the property, but what's the real value of the property? What's the cash as is value of the property?
$45,000.
Okay, that's because that's what he's buying it at. So 50,000 divided by 45,000 means now you're 11% over 100% financing. You're at 111% financing here. It's just a little deceiving. Now, I understand that you can package things up and there's nothing wrong with packaging things up in a way that looks attractive, and non-recourse means you're not going to sue me. I'm not going to let you personally come after me. And if I don't pay you back, you just get the property. Yay. And regardless of what condition it's in, oh, dang it, there was a sewer main leak or the tenant destroyed it or there was a fire, but you get it back. What does the investor who's borrowing this $50,000 have to lose? He got paid to create passive income for himself. He's getting in $870 and he's only paying you $500. Who in the heck knows what's going to happen 5 years from now? But if he needs to walk away, he put $5,000 in his pocket, $370 a month for 60 months plus 5,000. This guy can put 27,000 with 0 risk. So you're left holding the bag. He can walk away anytime. There's things that happen, or a year later, or 6 months later, and then all of a sudden you've got a headache. And this guy, if he has character equity and ethical equity, he'll stay in and make this work for you. But if he doesn't, he just puts that 5,000 in his pocket. Now, I understand there's a few closing costs he probably had to pay. So maybe he gets only 3,000 in his pocket, but still, look at that. He's north of 20,000 easy without any risk, and you're left with all the risk. So yes, this is like going to Las Vegas. I'm picking fun at it. And I'm just saying, if you do this, go in, and the same people buying the big, the land notes, okay? They bought it for 5,000, they sold it for 15,000, took 1,000 down, and it's a $14,000 note that you can buy for 11 or 10,000. Well, just know if that guy quits paying, all he loses is his $1,000 that he put down, and you're stuck with a property with a cash value of $5,000 if you're lucky. And so by the time you go through your foreclosure process, it can take you 2,000 to 5,000, depending. It's not even worth going after it, guys, unless you're going to go, oh, I'm going to own or carry out of it. And what are you going to do? Take $1,000? When I want to buy a property or I want to buy a note, I am packaging up the deal to be as attractive as possible. The owner finance value is this. The real cash value is this. It's telling you exactly there. And it's your job when you're investing in notes, it's your job to do your own due diligence. You have to go into the deal happy if it works out, happy if it doesn't, right? Or if they don't pay. Happy if they pay, happy if they don't pay. You can see that this guy, he'd have a pretty good business model. And those guys doing the land notes. And I think I mentioned in a class or two previous where someone was trying to sell me the note, and I was going to buy it from him at less than he bought it. He bought this little land note. And the only reason I considered it is because I had previously had assets in this general location. So I kind of knew the area a little bit. I'm sure he was sitting on it longer than he wanted. And he finally, a few months later, sold it for 16,000. He didn't even get a double out of it. But I only offered him like 7,000, 7,200. I offered him less than he paid cash for the property. I didn't offer him more. So he's just kind of hurting, wanting out of it, just to cobble together, shake a little bit loose. And I just said, at the end of the day, and then the conversation with the borrower made me feel a little bit itchy, squeamish. So I just said, why don't you let this season for a year and bring it back around? There's a lot of gullible people. And so, you know what? Gullible people, their seminars. And I always say you will pay for your education. If you're dealing in real estate and notes, you're going to pay for your education one way or another. It's just, do you want to pay for it up front or do you want to pay for it through experience? Which way do you want to go? So a little bit of money up front, partnering with someone else, getting some guidance, whether it's coaching or just consulting on a one-off deal, can actually make or save people tens of, sometimes hundreds of thousands of dollars. Because all you need to do is one deal to go bad and boom, that was an expensive seminar. And then instead of going, usually then people get all depressed and then they're ashamed of themselves and then they just quit. And then they don't come back and keep going, till they breach success, because it's just so daunting and so depressing. But, there's people that have come back from really big losses. Just they learned, they brushed themselves off. They came at it a different way, had some support, some training, and, they came back from it. For me, I've never direct marketed for notes before, but I've positioned myself in a variety of ways where people will bring deals to me. So most of the note deals that I have are usually brought to me by somebody else, whether they call themselves a note broker, a note finder, partnering with people who do drum up deals or have natural deal flow because they are heavily marketing. So those associations have gone a long way for me. I have created a lot of my own paper because I'm doing owner finance. Let's say in the mobile home on land space, the numbers work out pretty well. Buying owner finance property, okay, then I'm paying on the note. But then I can wrap that note. Okay, there I created a note, but first I got a note from somebody else. But for me, if I can get owner financing terms and then I can, create that spread, that's the easy peasiest, best note. I didn't even have to pay hardly anything for it, right? Whatever I put as a down payment. And a lot of times my end buyer will bring me more than what I put down. So now I'm creating positive cash flow. I got paid to create passive income, right? There, I didn't even have any money in it. Yes, I have what I've spent, which is a lot, over the years. But really, those are investments once you've created yourself into a certain place, then it looks like you create passive income out of thin air. The thing I'm going after right now is buying owner finance property. Okay. Because then also I want to buy front end partials of other people's owner finance notes. Those are my two things. Because you have to spend money to get a consistent going, but there's not everyone's going to give me owner financing. So what do? I need a way to monetize. So it's just the wholesaling type of thing or fix and flip kind of model. But I'm doing those, making it pay for itself, the marketing pay for itself while I wait for that 2 or 3 or 4 deals a year I can get with owner financing and make that thing pay me 2, 3, 4 different ways, right? And then a little bit of private lending. I mean, there's all sorts of different ways you can play. Once you understand both the property and paper side of it, you just play whatever comes through the door. The other reason I'm building a small business, even though it's kind of a lot, and it's expensive to run a direct mail campaign and keep on top of all of that. Not only can I sell off deals to make it cover itself, but I want a miniature small version of businesses that carry themselves so that if in the future the economy does some unexpected things, I want something that I can expand, right? Okay, this thing is running on its own. I'm getting 2 deals a month out of it. It's taking care of itself, and I'm getting 2 or 3 or 4 owner carry deals a year. But at any time, if I need to, and I got to provide my sister, my nephew, somebody, they need jobs, I can scale it up. To me, that's just part of my prepper mindset also. And just the fact that I've always felt that I'm just sort of here to just like help with a rough transition. If I buy a property cash and I carry it, then I've turned my property into paper. And if I want to recapitalize, I can sell off a front end partial note and do that very well and give my investor a very safe position so that I get most of my money back and then I keep the back end, right? Because I'm not counting on Social Security, a pension, nothing. I need to create my own pension. So a lot of times I don't take money out of the front of the deal. I take money out at the end. I just want that back end cash flow, back end lump sum payments coming to me as a nice surprise down the road. Now, if I can buy a property with owner financing terms, like I have several times, I don't need to take a bunch of my cash. I don't need to borrow some money from anyone else. I'm borrowing from the seller, right? So maybe they sold me a property for $350,000, and let's say I put $35,000 down, and they gave me 3.5% interest rate, fully amortized over 30 years. And I could keep that if it made sense as a rental or an Airbnb or something. Or I could say, well, I'm going to sell it for $400,000, take $50,000 down at 5%, and I'm going to, keep the spread. So basically it's wrapping the private financing, right? So we all have a hedge fund at our disposal. Our hedge fund is not centralized, though. It's not in one place. It's decentralized. My hedge fund in my market is all the equity in my market. So there's going to be at least 38% of the people, statistically speaking, that own their properties free and clear. They can loan me their equity. That amounts to millions of dollars of a decentralized hedge fund that I can go after. And the way I make a draw from that hedge fund is negotiating an owner finance deal for myself, which then I'll probably turn over to one of my kids, a friend. There's a lot of people that own their properties free and clear or nearly so. And that's how you go out and take advantage of that money that's even cheaper than bank money. Is there anything else? Thank you so much. It's such a pleasure to meet with all of you and see your faces, or at least your names, on the little black squares. Go out there and create financial solutions, just one mom and pop to another. And if you're interested in that land trust course, email me. I don't have the offer and the whole links and all that stuff set up yet, but email me at dawn@notequeen.com that you're interested, and I'll make sure you get an invitation to the class. Take care, everyone. You guys have a good night.